Steven Bankler, CPA Limited. In 1977, Steven decided to merge his two passions, entrepreneurship and taxes, to become a CPA. He's been solving his clients' problems for nearly 40 years, helping family-owned and closely held businesses lower tax liability, protect assets, develop sound exit strategies, and put money in their pocket. Steve, if you are ready, I will hand it off to you.
Thanks, Julie. I appreciate it. Good day. I'll say good day to everybody because at least we're in the same day, I believe. Let's get started. What we're going to talk about is some tax saving plan and tax ideas. And I just want to start by saying a tax deferred is a tax that's legally delayed. I've had various people and clients ask me, well, all we're doing is postponing taxation. Why don't I just pay it now? And that's a legitimate point of view, except that that takes cash flow out of your operating business. And most people, if they're a profitable business, can put that cash to work and make a better return than they can paying the taxes. If you're near the top tax bracket before state income taxes, and you can legally defer $100,000 of tax, you're borrowing interest-free approximately $40,000 of IRS's money that you can operate with. If you pay the tax, now you've got to replace that $40,000 with going to the bank and having them charge you for some money and using it in your business. So that's one reason, one important reason why we look for every legal. First, you want to have a way of not paying the taxes if possible. But the second thing is, can I legally defer paying the taxes and use the money in my business better than giving it to the government? So that's where we're going to talk about tax planning. Tax planning requires certain basic understanding. You have to know your method of accounting. You have to plan in advance before the transaction. It's very difficult to do any significant tax planning when the year is already over and your transactions have already taken place. You have the greatest flexibility in planning and tax minimization is if you think about it and talk to an expert or talk to a planner before you do the transactions. As I tell people all the time is there are multiple ways to go from point A to point B. After you go there, there are no multiple ways to reconsider, and one may be more tax efficient than another. So do it in advance of the transaction and definitely do it before the year is up. At the end of the year, you're just reporting what happened and have very few elections left. First thing you need to know is your method of accounting, because this is how your taxes are prepared. Now, there are three basic methods that we'll talk about. There's a cash basis, accrual basis, and other recognized methods, especially for contractors, percentage of completion, completed contract, etc. Now, for the cash basis of accounting, it's based on cash received and cash paid. You recognize income when you receive it, not when you earn it. So as a professional, I bill my clients, and if they don't pay me, if I bill them in November and they don't pay me until January, I have income in January, and they have, depending on their method of accounting, they may or may not have a deduction in November or January, again, depending on their method of accounting. I have deductions in my business are not when they're incurred, but when they paid. So if I go out and pay January's rent in December, since I'm on a cash basis, then it's deductible in December. If I pay my home property taxes in Texas or in our area, they send us a property tax bill in October, and I have the choice of paying it anywhere from October to January 31st without penalty. If I pay it before December 31st, it's deductible in that year. If I pay it in January, it's deductible in the year I pay it. So that's when they are paid. Now, if I'm in business and I take customers' deposits, if I am on, excuse me, if I am on a cash basis, when I have the cash, the unrestricted use of the cash, it's income. So if I am in some sort of specialized industry where a customer gives me half now and half on the completion of the job, technically on cash basis, I have, when I get the first half, I have income and I haven't incurred any expenses for it. So that would be one business that you might look at trying to be on accrual, which means that I don't recognize income until I earn it, no matter when I'm paid for it. And lastly, we have something called constructive receipt. Constructive receipt is when you have you can actually have, you receive the money, but you're trying not to recognize it. The simplest example of constructive receipt is the client mails you a check, and you're on a cash basis, and you receive that check between Christmas and New Year's, and you just stick the check in the drawer. Well, technically, you have the check. You could cash it. It should be income in the year that you receive the check, not if you don't put it in the bank until January 2nd. So technically, constructive receipt is a factor that has to be reckoned with. Some other things that are important on a cash basis of accounting, and the reason I stuck this in here is people quite honestly forget about this. When you borrow money, it's not income. When you pay money back, it's not deductible. How you pay for something usually doesn't determine when it becomes income. Now, the reason this is important is there are there are several businesses that factor their accounts receivable. Factoring is a method of borrowing against your assets, the account receivable. Factoring can be one of two things. You can sell the receivable, at which point, if it's truly a sale, you've got income. You can borrow against the receivable. So if you're borrowing against the receivable, then that factoring money is not income, and it doesn't become income until you receive payment from your client. So let's take this to the logical conclusion. I'm in a business that generates a lot of receivables. I borrow against the receivable. Now, let me stop and say that not only it's what the documents say, but there's also another tax called substance over form. I've had people say, well, I sell my receivables, but when you look at them, we've got a personal guarantee. We have an automatic buyback after 90 days where we have to buy the receivable back. We have a fee to do that. We have a reserve account that if a receivable goes bad, they deduct it to it. In all common parlance, that's a loan. I haven't sold the receivable. I've borrowed against it. They want to call it a sale because they're trying to get around usury laws or some other reasons. So the substance of the transaction is a loan. I get the loan, it's not income. Now, if I take the loan money and spend it on payroll, on rent, I don't have the income, but I have the deduction because I've spent the money. How I pay for something is generally immaterial as to when I incur it. So loans are not income, repayments not deductible. Credit card charges and advances are considered loans. So if you buy something on a credit card and it says that you bought it December 31st and you're on a cash basis, even though you haven't gotten a credit card statement until sometime in January, and even though you haven't paid the credit card company until sometime in January or February, if you're on a cash basis, the credit card company on your books is considered a loan. So if it's hit with a December 31st date, it's considered paid on December 31st by using borrowed money. Therefore, it's deductible if you're on a cash basis when it's charged. Now, I should note that only certain small and qualified businesses can use the cash basis. If you're a home builder, chances are you can't use cash basis. If you're someone who's dealing in inventories, doing over $1 million a year, you really can't use cash basis because you have inventories. So this is not available to everybody. But it's also the easiest to plan, maneuver, because now I can control when I spend something and I can control when I deduct it. The next, as opposed to accrual basis, which is the next screen, accrual basis ignores cash flow generally and says income is recognized when earned. Again, going back to me as the example, we're a CPA firm. If I'm accrual, I earn the income, I send the client a bill, I send the bill in November, it's not paid until January. If I'm on accrual, that's income in November of the year, not in January when I get paid. Conversely, my employees work for me, they work through December 31st, I pay them in January. If I'm cash basis, when I pay them in January, it's deductible. If I'm accrual basis, even though I pay them in January, I've incurred the obligation in December, it's deductible in December. So it's recognizing the expenses when they are incurred, not when they're paid. Now I want to talk about a couple other methods that are available for people who can use other types. Mainly completed contract method. These are for non-residential contracts. Now it can be non-residential contracts. It can be specialized manufacturing. It can be home build. It can be building strip centers, apartment houses, things of that nature. Typically, it's used in the construction business, but there are cases where you can use it outside of construction. The requirement for that is the contracts must be expected to be complete in 2 years or less. It must be a small contractor, which means less than $7 million annual revenue over the last 3-year average. And if you don't meet that, then you have to use a percentage of completion, which basically gets you back to accrual. If you're a residential contractor, that means you're dealing in apartments and residents, but apartments if they're under 4 units per building. Now you have no revenue limit. You can do $100 million and still be on the completed contract method. Now the completed contract method says that on December 31st, assuming December 31st is your year end, on December 31st of any year, I stop, I look at my contracts in progress, I figure out what my profit in all those contracts, and instead of including them in income, I defer that profit into the following year when the contract is finished. So I get to not guess, because accounting is just an educated guess. I don't have to guess on what my profit will be. I get to actually wait and see what my profit will be. And I can build up a nice size deferral of tax liability. Now I put down this here is Shea Homes. This is a recently decided case for residential contractors. And prior to Shea Homes, which was a tax court case out of California, we thought that a residential contractor, his contract is house by house. Shea Homes went to tax court and said, no, I have this project. I put in a golf course, I put in tennis courts, I put in all the amenities, and I build houses in the residential area. Therefore, my project is not each house that's sold, it's this contract, it's this project, the subdivision. Therefore, I'm not going to pay tax on my profits of the subdivision until I'm 95% finished of building all the houses in the subdivision, even if I'm building it over 5 or 7 or 10 phases. And the court said, you know, you're right. It is project by project. You don't have to pay tax. You can defer your tax liability. The IRS obviously didn't like the result of that in the tax court, and they took it to the Court of Appeals in California, the Ninth Circuit. And the court says, no, tax court's absolutely right. Shea Homes says you can do it on a project-by-project basis, not on a house-by-house basis. So now we have even a longer deferral period that we can defer taxes for residential contractors, which also includes residential subcontractors, if they can find a project to do that. The next things I want to talk about, switching courses a little bit, the next thing I want to talk about is there's something called a qualified domestic production activity. We call it a manufacturing deduction. Now, a manufacturing deduction, if you can fit in, is 9% of your profits are tax-free, limited by 50% of the wages paid. So if I have $200,000 of profits and only pay $100,000 in wages, then half of 100 is 50,000, and so my 9%, well, that's a bad example in my head, but because the 9% still work, 200,000 is 18,000. If I had $1 million, then 9% would be 90,000, but it's limited to 50,000 of my wages, 50% of my wages paid. So you want to see if you can fit this round peg into the square hole. Now, why am I talking about this? Because manufacturing is not what you think it is. Manufacturing is much broader than you think it is. And Congress even told the Treasury we want this liberally interpreted. So, one, obviously it's domestic because they want to encourage domestic manufacturing. And so it has to be done obviously in the U.S. Now, what are manufacturers? Well, in real estate, almost all construction is manufacturing. You're building something, so you're manufacturing it under the terms of the code. And remember, in real estate, you can drill and mine. You don't have to build up. I'm in Texas, which is oil and gas country. We build wells. Well, that's a structure that's going down, not up, but it's still a real estate construction. And in Texas, it's defined as real estate construction. And it can be improvements and remodeling go in there. Now, it can't be cosmetic. You can't throw a can of paint up and say, you know, that's construction. If you're adding square footage, if you're demolishing and rebuilding interior walls, if you're doing something like that, that's real estate construction. Architects and engineers have a strong lobby because even though those are services, they got Congress to put in the law that as part of real estate construction, if you're an architect or an engineer providing architectural and engineering services for qualified construction, you're in the manufacturing business and 9% of your profits come to you tax-free. Again, subject to the formula. Film and video production is considered manufacturing. Now let's take this to the extreme, and I can tell you a true story because one of my clients is a very minor investor in a Major League Baseball team. And shortly after this became fully effective, I get a K-1, which tells me how much his share of the income is. On there is a manufacturing deduction. So I call the CFO of the Major League Baseball team. I go, how are you a manufacturer? And she goes, well, you know, we're a manufacturer because part of the manufacturing is film and video. And I go, yeah, I know that. And she says, well, if you ever pay attention, most of the time, not only do they broadcast live our game, but a lot of the contracts require them to rebroadcast, thereby using the film and videotape that they just made of the game. Since they are broadcasting from a film and videotape, we are now a manufacturer, and we get 9% of our profits tax-free. And I go, oh. I said, so you don't employ ball players, you have actors. She goes, you're darn right we have. Packaging doesn't apply. So if you're doing some sort of packaging, that's not supposed to apply to manufacturer. However, that's in the interpretation of the case law says differently. Now, the reason I have this screen up is I want to give you 3 examples of people who we didn't know were manufacturers that the court said they were manufacturers. The first one is called Dean. Here's the classic case that the guy buys the wicker basket. He puts a bottle of wine in it, and he puts cheese, crackers, or candy in it, wraps it in saran wrap, and puts a bow on it. So all he's done is package things together. The court looked at him and said, no, you have a new product. You're a manufacturer. The second one is Precision Dose. Precision Dose buys medicines from the manufacturer. They buy bulk of a popular medicine, pick one, and then they put it in a blister pack and sell it as a, quote, new product instead of buying it in a bottle of 30, you know, based on a prescription that your doctor has given you. You now can buy it in a blister pack and have one at a time. The court came back and said, that's a new product. You're now a manufacturer. See, I would have thought that was packaging, so that means now I really don't know what packaging is. Gibson and Associates is a renovation case, and this was, again, in real estate, they were doing renovation, and it was, quote, substantial, and that's where they came up with no painting, no miscellaneous stuff. It has to be renovation, and they're a manufacturer. And lastly is Advo, which is a direct mail advertising. And Advo turned out not to be a manufacturer because you would go to Advo and say, I'm going to do a brochure, I want to mail out coupons, I want to do a direct mail campaign. Advo would sit with you and design it. They may make recommendations, but ultimately, you, the client, had total responsibility, had total liability. Advo, if they printed it and mailed it, you had to pay for it. So Advo in that case was a contract manufacturer, but really had no risk and reward in the product. So therefore, in that case, Advo was not a manufacturer. If anybody was a manufacturer, it was the client who incurred the cost and incurred the risk of failure and the risk of reward. And so Advo lost the case. Switching hats to a third thing I want to talk about is real estate improvements. The PATH Act was enacted December 18th, 2015. And by the way, if you all have any questions, just type them in and Julie will get them to us. Prior to the PATH Act, it was there was some temporary law on the books for actually a year or two that would expire, and we would never know if Congress was going to reenact it, and so we were always in limbo in the planning stages. The PATH Act has made some temporary changes, now, quote, permanent, for a couple of 3 years, depending on what it is. The prior law, non-residential real estate depreciation is 39 years, straight line. That's the law. In temporary changes that expired in December of last year, if you made leasehold improvements more than 3 years after placing a building into service, you could now, instead of writing it off over 39 years, you could write it off over 15 years. If it was restaurant property, again, it would be 15 years. And if it was qualified retail improvements more than 3 years after placed in service, it was 15 years. So you got a break. However, that was expiring. And as it was expiring, the PATH Act came in and said, we're going to make these semi-permanent. I think it's 3 years or so. So at least for the next several years, we know what the law is going to be. First thing we're going to do is, A, it applies to all non-residential improvements. So now it's basically the same last screen, a restaurant, commercial, whatever, as long as it's non-residential. For the first time, we now get bonus depreciation. Well, bonus depreciation usually doesn't apply to real estate. It normally applies to tangible equipment. It can be a car, it can be computers, it can be anything that is new. It has to be new, first placed in service with the person who buys it. And bonus depreciation says you can write off half of the property, half of the value, half of the cost is the word I'm looking for, half of the cost in the very first years, which is a tremendous write-off. The second thing is improvements are now qualified after the building is placed in service. No waiting period of 3 years. I have several clients that were in the process of building buildings, and we were trying to figure out how they could place the building into service before it was really complete. You build a shell, you have the electrical, but you don't put up the non-structural retaining walls. So it's like buying a building that you're going to customize for a tenant. The building is a square box, and then the tenant comes in, let's say it's an office building, and tenant A wants 10% of the property, and you say, okay, I'm going to put up a wall here, we're going to have walls here, carpet, da-da-da-da. All that becomes improvements after the building's placed in service, and now qualifies for A, bonus depreciation if you want 50% in the first year, or B, 15-year property instead of 39.5 to 39-year property, because the building has been placed into service. And the selection, or it can be what we call 179 property. If it doesn't cost more than $2 million, the qualifying property, you can write off up to $500,000 in 1 year. And it phases out at $2 million, so if you go over $2 million, then the phase out comes in. All right, going on to the next subject, let's talk about our foreign businesses or foreign companies that have an affiliate or own a business in the U.S. One thing that they can do is they can have, what we call arbitrage the tax rates. As many of our U.S. citizens know, the U.S. corporate rate is one of the highest in the world at 35%, and that's before you add on state taxes. Foreign entities can own a U.S. company, and then they would also pay 35%. But they can provide capital, they can provide services, they can do various things for the U.S. entity and charge a fee for it. So if I'm from out of the country and I loan, or I provide management and accounting services to my U.S. entity, and it's $50,000, of value that I give them at fair market value, then the U.S. entity can write off that $50,000 and lower their profits by $50,000. And then I move that income, and if it's being provided by a subsidiary out of a low tax jurisdiction, then that low tax jurisdiction has $50,000 worth of income. So think Apple on a grand scale. Think Google. They use Ireland because Ireland has, for Apple, it's less than 4%. So they can effectively move millions of dollars out of the U.S. profits and have that, instead of paying 35% tax on it, which is $1 million to $350,000, and if they paid a 5% tax, you went from $350 to $50. So where you decide to have income tax is an important consideration if you're doing business in multiple countries. Before I leave this, I want to give you another true example. Is Starbucks in the last several years is on every corner, not only in the U.S. but in London and in the U.K. And yet all their U.K. filings say that they don't have any profits; they have losses. They recently settled with the UK version of the IRS to pay them in lieu of because they had no profits, $100 million in tax. Now, I'm not a rocket scientist, but I guarantee you, if they agreed to pay them $100 million in tax, those unprofitable stores were only unprofitable because Starbucks could figure out ways to charge expenses in from other countries to the UK and move that income somewhere else and have it taxed at a lower jurisdictional rate. So now let's talk about retirement plans. And the reason I want to do this is that, again, prior to year end, after year end, you can't set up very sophisticated, complete retirement plans should you think to do that. Now's the time to do that. Matter of fact, this slide was done earlier, and some plans require to be in place by October 1st. Obviously, that deadline's gone. Other plans, they have to be in place by December 31st. These are profit sharings and defined, and you can, what does it mean to have them in place? It means that it would be better if your documents were signed, that you've already made decisions. But I believe you could go to well, it's going to be hard to go to a bank and open up a plan if you don't have a document, because the bank's going to want to see a document. But if you opened up a bank account prior to December 1st, that shows that you have the requisite intent and the requisite documents, especially if you're going to a planner that needs time to draft a document and may not be able to get the documents to you in time for December 31st. And these are just looking at running numbers. Can I take a profit sharing plan? Can I convert it to a cash balance plan, which is a richer plan? And depending on the age of the owners and the salary of the owners, you can legally discriminate against the lower paid and put more money away for the highly compensated with giving lower paid a disproportionate less share of the plan. And if you think of a plan as a pair of pants, as a matter of fact, if you think your entire business is a pair of pants, and you have one pocket for a plan, another pocket for the business, another pocket for your personal, is that they're all pockets that you own and control. Is there advantage or a savings by taking money out of your left pocket, moving it to your right pocket, and you're getting a tax deduction? You may have some restrictions on can you use the cash, or do you have to include other people in it? So these are things that need to be thought out and qualified and looked at. Let's have a brief conversation on financial and estate planning as well. First thing to look at is, what is your business structure? And the reason business structure is important is that you will be selling or disposing of your business in the future. You may not be alive for it. It may be your estate that sells it. There's a possibility you could sell it. There's a possibility you could close it. But there is going to be an exit, one way or another. And you need to do that. And certain structures have inherently advantages and disadvantages to them. And you cannot change structures easily, and you definitely can't do it within a couple of years of sale and expect to recognize all the benefits of a change in structure. So this is one thing that needs to be looked at. Certain structures give the buyer incentives so that they get what we call a step up in basis. If they're paying you for the value of your business, they can take an immediate deduction over a period of time of that increase in value. If they're buying goodwill from you. In the old days, you couldn't take goodwill as a deduction. Now you can amortize it. However, if you're a C Corp or a certain type of corporation and they're buying it, they may not be able to take advantage of it. So what you're trying to do is get your situation set up where the buyer and the seller can both maximize their money that they have after taxes. And they actually need to work in conjunction with each other. If you take a classical case where a buyer buys the business as a C corporation, which in small businesses almost never happens, but everybody thinks it's going to happen. If I'm going to sell my C corporation for $1 million and the buyer is in the top bracket, he's got to earn almost $1.7 million to pay the tax and have $1 million left over. That when he gives to me, I have $750,000 left over. So we went from $1.7 million to $750,000 at the back end for me. Now, the maximum federal rate is 45%. Yet we've lost on a $1.7 million transaction $1 million, which is way more than 50%, probably 60%. Now, if we restructure the deal and we make it all deductible at some point in time to the buyer and all ordinary income at some point to the seller, the buyer could actually pay $1.6 million. The seller could pay ordinary income on $1.6 million and have, instead of $750,000 left over, close to $900,000 left over. At which point you go, well, who cares what rate I have if I have more money in my pocket? So it needs a cooperative basis. Now, you can only do that with certain types of business structures. The time to do that is long before you've got your business up for sale. You need to look at structures. For estate planning, you also need to look at types of insurance and make sure you have insurance. You need risk appropriate for the investment. Actually, you got to have guidance, obviously, from experienced advisors. And the last thing is to consider is my assets outside my business. Do I need family limited partnership if I have substantial wealth? And the reason you want to consider that is, no surprise, under the Obama administration, they've just come out with changes in that rule, or they have proposed. Let me rephrase that. They have proposed changes in that rule of using family limited structures. On August the 2nd, they've proposed a rule. And let me give you an example of what the rule is before it changes. The rule is, let's say I have $1 million in mutual funds, and I put it into a family limited partnership, and I hand out units of that family limited partnership to my heirs. And I give one heir 10%. Well, that gift is not 10% of $1 million because they don't have the rights to that mutual fund. What I've handed them was a 10% share of a family limited partnership. Now, they don't have the right to sell that share. They may only have the right to vote that share once a year, and that's just a vote on who continues to manage it. And I have more than 50% in control, so that vote, while we take it, is meaningless. They have no rights there. So when you take in the valuation of that $100,000 gift, you're down to $60,000. So you've done some sizable discounting. Treasury, and that was the Kerr versus Commission decision in '99, that says we can do that. Treasury doesn't like that, and now is trying to change it by rule to say if that recipient of that 10% is an heir and a family member, then that ownership hasn't left the family. And therefore we're going to not give you a discount, and what you've given is that 10% of that $1 million, and you've made a $100,000 gift. So I'm suggesting that through the process of Treasury, if they act at lightning speed, they can't get this approved before the end of the year. And so there is a grandfather clause that if you've established it and used it before these rules become final, then I doubt, then you come in under the old rules. So it could be as soon as, they're not even hearing on it until December 1st, so I'm sure there's no way they're going to have it done in 2016. Congress is already talking about freezing the rules in place and taking that decision away from Treasury. Obviously, they're not in session now, but there has been talk to do that. And I can just tell you that Treasury doesn't always move fast. In the late 60s, there was debt versus equity rules that were proposed and withdrawn and reproposed, and they've been reproposed, and now they're trying to move forward because they're trying to stop some inversions of corporations leaving the country administratively. And so it's been 35 years since they've had regulations on that subject, and so usually Treasury doesn't wait quite that long. They usually move a little faster than a snail's pace, but don't forget, we're also going to have an intervening election between now and the first year. Depends on who the administration is. Depends on the makeup of Congress. Depends on whether whether a bill can even get through Congress. So I'm telling everybody it's better to be safe than sorry, and you ought to think about doing something by year end. I believe that ends our seminar, and I've said basically what I want to say. Julie, do we have any questions that you've gotten or comments that people want to talk about?
Sure. So I did have one question. Kind of looking back when you talked about businesses being able to be on a cash basis, you said that there were some qualifications as to certain businesses that could and could not. I just wondered if you could expand on that a little bit.
Sure. If you're dealing in inventories, you're a retail store, or you're manufacturing and you're buying raw materials, you have to account for inventories on an accrual basis. If the simple example is I have a shoe store, and at the end of the year I run out and I have a great year, and this year my profits are $1 million, so I run out and buy $500,000 of shoes to sell the following season. They're sitting in my store. That really is not an expense. If I were on a cash basis, that would be an expense, and I would write off the $500,000 in shoes and cut my profit and then have them the following year. But because I have inventories, I have to account for inventories, and all I did was change cash into inventory. That's not a deduction. I don't get to write off the shoes, and therefore I can't use it. So if a business does less than $1 million, unless they have to have inventory, they generally can use cash. If they do less than $3 million, and they just a whole variety of businesses that can and cannot use cash, and you just have to check out your individual situation.
Okay, great. Thank you.
Uh-huh.
So far, I'm not seeing any, but just going to mention real quick. If you do, go ahead, please type them in. Steven's information is up there on your screen, so if you have any further questions that we don't get covered, feel free to reach out to him directly. We do have one more, thank you, from Greg, and he says, can you please speak about the advantages or disadvantages of employing children in the business?
Okay, the advantages are, first of all, you can employ children in your business generally. The advantage is that the deduction that you get for them is for reasonable compensation. Don't ask me what reasonable is, because the courts have it all over the map. But that's what the law provides, is reasonable compensation. You have to pay payroll taxes, which is Social Security and income taxes on it. However, Social Security taxes. However, they do file their own return and have to report that income, usually at a much smaller rate. If they're a dependent on your return, you may lose that exemption depending on their income, unless you're providing over half of their support. Once they have earned income, they may qualify for putting money into an IRA, a retirement plan. If you have a retirement plan, They can have a payroll deduction to join your retirement. They would have a payroll deduction to join your retirement plan. That money, earned income, is also available to put away in what we call 529 plans, which is no deduction, but it gets to grow tax-free. So there are pros and cons to it. The biggest con, or the biggest reason, is that legally and technically, now I'm not a lawyer, but I believe most states provide that if that's the child's earning, then the child can spend the money any way they want. Of course, if that money were deposited directly into their savings account and they're not aware of it, then it's hard for them to spend it. So that's why you also want to take care and not pay your 7-year-old for cleaning up around your office $30,000 a year. While that may be reasonable, that means that they have access to it.
All right, thank you. We had another question come in from Peter, and he was wanting to know, when did qualified domestic production credit come into effect, and can this be taken away in the near future?
Well, first of all, it was passed under Bush 2. My memory is 2001, 2002. It was a 9-year phase-in. It started out at 3%, then went to 6%, then went to 9%. It hit 9%, I want to say 2009 or 10. Anything can be taken away. It's in the law, so it takes an act of Congress with a presidential signature. That doesn't mean it can't happen. The reason it was put in, as a little background, was the U.S. was in a trade dispute with the World Trade Organization, and they said that something in our trade agreements or something in our tax code was giving an unfair advantage to certain manufacturers. We were subsidizing exports, which is a no-no in trade because the country that you're importing to doesn't want you subsidizing their exports. To them, to make that product cheaper than their domestic manufacturing. So Congress and the administration came up with this manufacturing deduction to give it to everybody, so there is no subsidy on just exporting manufacturing. I find that in our practice is that through speaking is that a lot of people are not aware of this, including several CPAs and tax preparers, and a lot of them who are aware of it think of it as classical, in the classical case of having a production line of widgets being manufacturing. We've picked up numerous contractors that had not been taking construction companies that had not been taking advantage of this, and so I don't know, I don't know how else to answer the question. But it's available. They can take away your itemized deductions tomorrow if Congress passes the law. So it's as permanent. It doesn't have an expiration date like the depreciation adjustment we talked about.
All right. Well, thank you very much, Stephen. And it looks like we are done with questions. If you do have any, like I said, his contact information is right there, and you will actually get the slide deck later today. So feel free to reach out to him. And you can check out all of our previous BOSS webinars on demand by visiting our website and clicking on webinars. At that same place, you will also be able to register for our November session very soon, which will be about recruitment. Thank you, everyone, for joining us today, and we hope that you have a wonderful rest of your day.